Greetings, market rebels. Welcome to this week's sector situation. It is Sunday, August 27th, 2023. It's 5 minutes before noon here in the East Coast. I'm Wayne, and I will be doing this for a second time because it looks like we had a recording issue for some reason on the first one, which is very frustrating, but it is what it is. So we'll do the best we can to get another one cranked out here. Here's the trusty disclaimer. And then here is our trusty intellectual property rights notice. If you memorize those, we'd appreciate it. And then final thing will be a flashing of this week's stream from the macro measure video, just in case you want to take a screen cap and place this over to the side and just review. These are kind of the big picture things that I think did happen, may happen, are I think things I'm watching. I think a lot of people probably are where I'm at just in my thinking. And it's more of a tough call this week. And the sectors themselves reflect that as well. So let me stop sharing this screen and let's start to share a different screen. So stop that share and let's get us back to, excuse me on this. We will get over to screen 3, which should really be the sectors, but I'm going to probably go through this more quickly because, again, I just had something blow up on me where it just did not record. And I remember clicking that button. I don't know if it just didn't click properly. I don't know. Something strange happened, but starting out with the grid of 12, as we often do. And all I really want to note, again, is the RSI readings to start out with, where you can see there's a lot of these that are in the 40 range, right? And you can see that transports, staples are some of the ones that have been smashed the most, along with XLB. Everything else is pretty much somewhere in the 40s or 50s in the case of XLE. So this kind of fits with my macro take, which is it's a tough week this week. I think you have to trade the range we're in. I covered the swing high and swing low, and the SPY pretty much applies to the Qs as well, which are the two big ones we keep an eye on. Mainly, right, because they represent, we think, the market the best. But XLE is probably worth covering here, where this has been a leader. We still like, let me just make a little adjustment here. We still like the way this looks overall, but let me see if I can get a chart in here that would be helpful. XLE, there it goes. See XLE, and there it is. Yep. So we'll come back to this, but this still looks good in the long term. But as you can see on here, right, these short-term moving averages are, I want to make sure this is working now. I'm getting a little concerned because of what happened before, but they're starting to roll over here. So it can't be ruled out that you don't pull back a little bit more. But at the same time, they put 3 bullish candles together. So is this corrective action over now after about 2.5 weeks of pulling back from the high? Could they rip things through? And this is a great example for people, I think, that are new, that don't understand why somebody that trades off of technicals would flip from bull to bear so quickly. But if you get through here, right, and you close above here, you'll be back above all the SMAs, which is a positive sign some people like to see. If you get back above here, right, you have all the recent closes that you will have eclipsed. You're only really left with these two. So it wouldn't take much to go right back into, I'm on the verge of another ramp higher, right? So that's why people would change their mind. And you've got some candles here where it looks like they came in and on the news that caused the weakness, basically bought stocks in here, right? They basically bought from the opening. That's why the candles are green. So it's hard to say really that, hey, definitively this thing's, a screaming buy or sell. It's really where I would, again, probably play the range. You start breaking out, I would say, look, it's corrected enough. It got down in terms of the corrective activity on the chart that I'd be willing to trade this on the long side. At the same time, if it fails to do more than this and starts rolling over again, you just can't rule out a visit to the 200 in purple or the 50 maybe in gold. Not that it's a huge drop, but you can't rule out that there's going to be a little bit more, and you can see that the short-term SMAs are rolling over. So it has its own unique characteristics. You have to really be, if you trade this day in, day out, you've got to be attuned to what's happening in there. That's that way with most sectors, but I think especially something like energy, you would have to do that in. So let's see. I want to get back to my grid, which should be up here. There it is. So I don't want to get too deep into the weeds, but otherwise, right, this consumer is not looking great in a couple different ways. XLY discretionary, right, that's just gotten routed. They took basically in what they did in July was more than erased in August. So not good there. Excuse me. Transports are telling you, things aren't really firing all that well. They don't even care to get into staples. That's kind of scary in a way, and it kind of leaves me scratching my head that usually a little defensive positioning there. Another defensive name like XLV, the healthcare, that's on the verge of losing this critical support. That could drop off. And utilities, of course, are seen as very defensive, but with rising rates, they're probably under pressure from that. And I think that's why the market, to me, should be under pressure, has been under pressure. Rising rates, rising dollar, and things that have held out. I think if rates continue to go, you may as well. I can't say definitely, but I think at that point you start making new closing lows, and this stuff with like rates really powering, and your XLB and your XLI are just vulnerable. There's gaps pretty far down there, and you could really get more of a washout. So I think that's why, excuse me, I can't really get super this or super that in terms of I can't get super aggressive in terms of where I am in the market. And that kind of makes it the case in a lot of the sectors, because a lot of the things that would be like, hey, are we in a healthy economy? Well, real estate not looking wonderful. That certainly doesn't look stellar. Financials do not look wonderful. Now, could they rally? Sure. From here, no doubt, right? They might rally, but it's not like they're in this really great technical let's say spot, right, or juncture that they're like ready to scream higher and break out and make new highs. It's just not there yet. And even former leaders like XLK and XLC look vulnerable. So there's still a lot of vulnerability out there, but they did save the market on Friday. We did go from risk off, where virtually every sector was down at one point, to I think 10 out of 12 sectors that were up. I think there's only one or two red closes, XTN, and what else was red? Well, I take that back. There was only one. It looks like 1 out of 12. But at one point, I think 9 or 10 out of 12 of these sectors were definitely lower. So they really saved the market, in my mind, on Friday. And like I've said before, it's hard these days, because in the old days, I would have said, well, that was late summer shenanigans. It was on a Friday. It was an expiration shenanigans. That's not going to last. And that would have been probably the case 20 years ago. But I would say in the last several years, I've really had to say I can't be as emphatic, because I've seen plenty of those dubious saves, is what I would call them, extend into at least Monday, if not longer. Excuse me. So it is what it is. And I don't want to read too much into that, but they did save these sectors. And so remember, you go and look at macro measure, the sweet spot that we just left, that leads to not just downside, but volatility. So there can be some serious back and forth. And after the kind of August we've had, they could try to put some upside together. It's already been a pretty rough month. On the flip side of that, if August ends poorly, I think that pretty much seals the deal that we're going to have a couple more months of rough stuff in the market, where it just won't be easy upside. Just be long, be happy, and just make money. I think it's going to be a lot more just back and forth, if not skewed more to the downside. So with things really being risk off in the morning and then risk back on in the afternoon, I think you can see that there's little variations, and we know there's certain sectors like energy are going to get ruled out. But if you notice August, if you look at just the August on this grid, almost all these sectors got hit, which because the market itself is getting hit, and so almost all of them went risk off, just like they were all risk on in July. So there's not a lot of independence here where we could really say, hey, let's focus on this because this is emerging in a bull market. It's just not there at the moment, right? And things like this is a little bit more defensive. We would think it's hanging in there a little bit better, and so maybe give it its due. And remember, if energy starts to ramp, that probably is great for the energy companies, but it's probably not great for the American consumer, consumers abroad, excuse me, and Europe, Germany, and also China. Like, things are not firing. They're just not firing in a big way globally. So it's problematic right now in terms of the consumer. So again, putting more pressure on the consumer, not good. A lot of you know, I like to look at these three sectors: energy, financials, and transports, and they're not really looking great. Energy is its own thing, I think, right now, as it often is, but I don't think that's really indicative of robust economies. I think it's more specifics related to the energy market itself. Financials look a little better, sure, but they're just they've corrected dramatically. Transports have corrected dramatically. Could there be a little relief rally? Yeah, but as of right now, they're not at a juncture where you'd say this is where they break out and scream higher. That's indicative of really great lifeblood, if you will, running through the financial system, and great transport developments, right, where so many goods are being shipped that this economy is really roaring. So I think those are problematic, just in a kind of the macro way. And I think these leaders kind of looking potentially broken and below trend, their goose is not cooked yet, but it wouldn't take much for their goose to get cooked. And it also wouldn't take much for them really to work themselves back up towards trend resumption. So I think you're in that tough spot that a lot of people don't like, where you're just not in a very high confident area that you can be bull or bear. And you're better off just take what comes your way and trade it as best you can. And you could see, again, well, energy, that could even be argued in there, which is probably one of the better looking sectors overall. If it can close the month out strongly, I think it'll be definitely a good looking sector. But if not, and it doesn't close it out strongly, that would, again, kind of be a little bit more turtled up, and I wouldn't be so willing to be a bull in there. I'm going to be a bull more so if it closes this month out strongly after spending 2.5 to 3 weeks pulling back. But let's look at some other things related to. We saw the XLRE. Excuse me. So let's look at the XHB as it relates to that. Well, actually, what I'll do is I'll go back to XLE, and we'll just take a look at the oil future, which is what I did last video that did not record. And I just love when that happens, by the way. Boy, that's just frustrating. But I don't think we're slowing down on me here, but you can see that the XLE and the crude oil future look very similar. So I think it's good that they kind of held out here above their long-term moving averages and is ready. If it can get back above the 20, right, I do think it starts to attempt to take a run. That's what I would be looking for in there. But that's basically the same thing in your XLE. So I just want to be thorough and cover that. But it did correct enough, and the momentum is on its way back up at the moment. So I'm willing to give it the benefit of the doubt still as a bull for that reason. But again, I would flip on this, not in a big way that I'd hate it, but I'd be willing to take a downside trade if it can't hold really below. To make it easy, let's just use Wednesday's open of 86.62, excuse me. So you probably should be a little more patient than that, maybe 86.50, but just in that general vicinity is where I would be looking at. If it can't hold there, that it probably breaks down towards that 200 in purple. But let's look at XLRE just for a refresher. And then we'll do XHB, and then we'll take a look at some of those lumber ETFs and things like that. And we're getting Thinkorswim's getting us on the percentage switch over. But here's your XLRE, right? And you left that channel. I think everybody can see that. You're below all your SMAs practically. It barely scratched out a closure above the 10 in white on Friday. and your short terms are downsloping. So that's not really a great look, right? That's not where I'm pounding the table to buy. I'm a person who likes to wait for the momentum to display itself a little bit more. In this case, as a bull, if I were a bull, it would be hard to be a bull because of all that SMA resistance that's waiting for you, along with other forms of resistance. But still, you could take a trade there, see if you can get up to the 200 in purple, whatever, near 37.65, something like that. Nothing special for now. But I mean, overall, if you're below your recent channel and you're below mostly all your SMAs, with some of them downsloping, not really a great complexion. And then if you look at XHB, which is what I've been working towards, this does not look all that wonderful as well. You've got to say, well, yeah, sure, it looks better than maybe the commercial real estate ETF, a little bit better, but excuse me, not a great day there. Certainly better than closing on the low, but that looks concerning. Shorties rolling over below the 50 in gold, made a new low, right? And we've had an idea on in here on the downside, XLI here, XRT, other things that we're kind of waiting on for them to finally potentially correct. The paper showed up. We got those bearish ideas in there. I think some of them are still active, but I would think, look, I think the 100 there makes a lot of sense, that if you're going to get another leg of selling, the 100's at 75.82, it looks like right now. So if you're there, that's what I would look at, that you get if you get another leg of selling, there's a little bit more downside to that point. But right as of right now, they're trying to turn it just like they are the other things, excuse me. But with that, remember, this is the relationship in my mind, right? Yields going up. You can see where the trend of yields, they did correct. They're holding right below the 10, right above the 15 in red. There's a rising 20. There's a rising 50 in light blue and gold, respectively. So as of right now, like, until they crack that 15 at the very least, which would be last week's lows, put another way, right? I probably would give that the benefit of the doubt. Not that it's not to say that it maybe isn't due for a little bit more of a pullback. It's just that for now, right, we just don't know what Monday will bring. But those have trended up, and housing is finally stopped and reversed a little bit. But related to those are the ETFs, wood and cut, that we've been looking at since we can't get the lumber futures. And they're just mired, right? There's nothing there that you could say, well, this is great or this is horrible, right? Because they're kind of intertwined right in that ganglion of all those Fruit Loop SMAs. And they're trying to come back from that low that they put in the week prior and last week. So they're still trying to work their way back up. They haven't broken back down thanks to the save that went in on Friday. They look just about the same. But look, they're breaking down. They were not able to break out. So when the short-term moving averages are downsloping, so if you want to give it the nod, it's sort of like, momentum's trying to get back in place. It's trying, but the SMAs are all waiting for it. Could be a hard slog again without big news to develop. And the SMAs in the short term are downsloping. And a lot of the shorties are looking across the longer term SMAs. So I don't really trade off of that. I just note that because I know a lot of people like to look at SMA type behavior, and there's nothing wrong with it. It's just that I like other things that I've done before I even really got into SMAs. I was just doing other things that I like more, fortunately for me, at least. But again, there's nothing wrong with using these SMAs, and a lot of people get a lot of value out of them. So it's just all about how you view things and what you prefer. So on that note, let's look at copper while we're near sort of the commodities with lumber. And we did note this on the prior video that failed to record, but this is just not looking wonderful either, right? And they call it Dr. Copper for a reason. And you can see that it's also mired. There's really nothing awful about it at this very moment, but overall, it's below most of the longer term SMAs. The shorties are pretty much flatlining at this point. Some of them are downsloping. Some of them, like the 10, is starting to upslope slightly. The 200 still upsloping. So there's a battle there, and that's what I mean. It's mired. There's just nothing that we can say like, oh, this is incredible. This is signs of something. We would need to see this start to really break out to say, yeah, the world economy somehow managed to start heating back up again. Excuse me. But it really, yeah, it really hasn't. So, yet you just came off of a new sort of like 6 month, or sorry, a new multi-month low, I should say, about a week and a half ago. And so this high that gets put in here tends to be turns out to be the high, and we roll over again, it will be a lower high. Your moving averages would worsen, so on and so forth. And that's just not a good look. So nothing's really looking good. I mean, transports, other than to say that these things are maybe bombed out, this to me is not a great look. Look what's happened here. I mean, I don't think this bodes well for the economy. I'm not saying you can't balance the trade up from here. I'm just looking at it as more of a macro assist, right, of what we're looking at. And I just don't think this looks great. Now, if it holds here, it would be certainly better than not holding here. And it would be like, okay, well, it had a good correction. It still has higher lows put in, and maybe there's a whole nother leg that's about to unfold. It's probably early to say that, but I'm just looking ahead. But overall, yeah, I'd be concerned about it. So I'd be very concerned about what's going on there. That's really fallen apart. It's almost like, something's come off the rails, and maybe that corresponds to the credit card information that we've been talking about, which has to do with highest rates in maybe a long time and highest balances in a long time. And then more people, I think it was more people are now rolling their balances from month to month rather than paying off their balance fully. And I think they said in the report I saw, I think it said the first time that's ever happened. So I don't think that's a good sign. But again, I think a lot of these consumer sectors do not look that great, other than the fact that they've already corrected. So it maybe is too late to short them with reckless abandon. You could still maybe go short, but look, the thing's at 31 now. It's already at 31 on the RSI. So again, I think when you come in, this would not be in inning number one in terms of intermediate term trading. You have to admit that I am not in the first inning when something goes down for nearly a month. So you're not, you've got to treat it like, okay, shorter leash, right? Shorter leash, in my opinion. That's how I would handle that. And just, if it gets a little rally together, great. Then you look for the weakness and it rolls over again. You get a better shot at getting in higher with less oversold conditions, that kind of thing. But I just don't think this looks good. So a lot of those bigger sectors simply do not look good. And as I noted in macro measure, the dollar and TNX are still threatening, and the VIX is set to rise. So over the next few months. So all in all, right, it's pretty challenging right now. I don't think there's a standout sector. I think what you should watch out for are how things close, right? How the sectors close out this month on Thursday, how these index ETFs close out this month, which we chart because it's easier for folks to trade this than SPX or NDX or whatnot. It's easier to trade the Qs than that. But if you get a rough close, that could portend more rough stuff. So the third year of the presidential election cycle suggests we have a couple of more months of rough sledding where we're going maybe back and forth somewhat violently with some volatility. And then we close out the year in November and December with a typical rally phase that carries well into the fourth year, which is next year. And so we can't rule that out because that's been a very good cycle to track this year, we think. And given that, right, we're open to entertaining that after this corrective action we've seen in August, that the gang may try to put some kind of a relief rally together, and who knows what they can do with it. But again, I would keep my eye on the TNX and, well, bond yields in general, and I would keep my eye on the dollar. And if they continue to move up strongly, I would take the downside very seriously here, compared to, I think there's a possibility for a real break in the market if these yields if you get the 10-year screaming towards 5, I think that could be problematic for these equity bulls in a pretty big way. And I think there's been so much money that's entered this market thinking that we were at the dawn of a new bull market, that they'd really have trouble on their hands as a result, because a lot of them, I think, went really big into believing this. So just kind of keep that in mind. But as of now, if you close out the month pretty strongly, that may help that third year remain intact more easily, where the technicals wouldn't look so bad based off of how ugly of an August we had, because we didn't close very poorly. We closed on a much better note. If they manage to pull that off, that probably does make a couple of months of back and forth likely, followed by rallying and preservation of that presidential election cycle analog we've been using. If, however, things close poorly, I think it puts a lot more pressure on that third year, and it probably means that we have a whole nother leg of corrective activity, whether that's just the start of something bigger or just another leg that finally peters out near the 200-day in the SPY, and then we start to rally from there. I don't know. I always would rather approach it when we get there and see how things are shaping up, rather than making the long-term projections, because I maintain that the key to being successful as a trader is to adjust along the way. Be kind of turtle up when you have to and get aggressive when you have to, but it's easier said than done. But anyway, I hope something that I shared with you helps you out this week or in an upcoming week in the future. I want to thank everyone for tuning in. I want to wish everyone a great conclusion to their weekend, a great week ahead. And we'll see you through updates and webinars, etc. Thanks again for tuning in.